Planning for the future often feels like a constant tug of war. On one side is the instinct to protect the money we have today. On the other is the quiet fear that we might run out of that money by the time we're 80. For many of us, the natural reaction is to play it safe. We leave our cash in a basic savings account where we can see it, or perhaps we even keep it in a home safe. It feels secure because the numbers don't change. But there are economic forces at work that can make it worth significantly less by the time you actually need it. The primary force we're talking about is inflation. You can think of inflation as a silent thief that steals your purchasing power every single year. Because prices for things like milk or rent slowly go up, $100 today won't be able to buy as much 20 years from now. This mathematical breakdown shows the real impact. Most people focus on the interest rate a bank or bond pays, which professionals call the nominal return. If that sticker return is 10%, but inflation is 5%, you only actually gained 5% in value. That 5% is your real return. Because of that math, simply saving your money is rarely enough to win. To stay ahead of the silent thief, you have to invest your money in ways that grow faster than the cost of living increases. Participating in financial markets provides that growth. These markets act as engines for the economy, allowing your savings to work for you so you can maintain your lifestyle for decades to come. You can imagine the financial market as a supermarket with different aisles. Each aisle contains a different group of investments, and they all have different strengths. The first group is fixed income. Think of this as lending your money to a bank or the government in exchange for interest. It's a steady worker that provides you with safe, predictable income. However, fixed income has a limitation. Its growth is often very modest. Over a 30-year retirement, it might not grow fast enough to stay ahead of inflation. Then we have equity, which is the ownership of shares in companies. Think of this as your growth engine. Over long periods, equity has the potential to grow much faster than inflation. But equity introduces volatility. This jagged line shows that while equity goes higher, it moves in unpredictable, stressful swings. This graph shows the financial world's basic trade-off. Higher equity returns mean higher volatility. Fixed income stability means lower growth. A retirement advisor helps you find the right balance between these two extremes, tailored specifically to your life. They use a process called risk profiling. This involves looking at your age, your current assets, and your family situation to see how much volatility you can realistically handle without feeling the need to panic. A good retirement strategy is built by matching specific investments to your personal financial needs and your psychological comfort level. The good news is that you don't have to pick just one side. You can use both tools together to protect your future from both enemies at the same time. This is called asset allocation. It's simply the strategy of dividing your money between your growth engine, equity, and your steady worker, fixed income. Many people use a life cycle approach. They use more equity while they are young to beat inflation, and then slowly move toward the safety of fixed income as they get closer to their retirement date. The orange bars in this chart show why starting early is such a massive advantage. Because of the way returns compound over time, starting just 5 years earlier can lead to a drastically larger result in the end. When you have the right mix for your age, your asset allocation acts as a suit of armor. It protects your wealth from the swings of the market today while keeping you ahead of inflation tomorrow. Let's check your retirement readiness. First, do you see the difference between saving, parking money, and investing, growing it? Second, can you identify your two main tools, fixed income and equity? Finally, do you recognize that higher growth requires risk, managed through asset allocation? We want to know your current focus. Are you more concerned with beating inflation right now, or are you trying to avoid market volatility? Let us know in the comments and subscribe for more. Building wealth for retirement is a process of disciplined, balanced investing. By understanding these two enemies, you can build a plan that carries you through for the long haul.